Bitcoin's recent dip isn't about crypto, it's about the dollar. But here's where it gets controversial. If you've been scratching your head over Bitcoin's latest pullback, you're not alone. But here's the surprising twist. It's not crypto-native flows driving the decline. It's the US dollar, according to Jamie Coutts, chief crypto analyst at Reversion. In a recent analysis shared on X, Coutts presented two eye-opening charts that reveal a macro story far bigger than Bitcoin itself. And this is the part most people miss. The rebound in the US dollar index, DXY, is temporarily tightening global liquidity, putting pressure on risk assets across the board. As Coutts puts it, Bitcoin's dip isn't mysterious, it's macro. Why is Bitcoin down? Let's break it down in a way anyone can understand. Coutts explains that the dollar's recent rebound is squeezing global liquidity. The DXY is retesting the 100 to 101 range, a critical resistance level and natural mean reversion zone after one of the sharpest declines in decades during the first half of 2025. Here's the kicker. Positioning in the market had become heavily skewed toward betting against the dollar, so a bounce was almost inevitable. But the million-dollar question remains. Is this the start of a new dollar cycle or just a temporary setup for the next leg down? Coutts' base case is optimistic. He believes liquidity tailwinds in an improving global business cycle will keep the outlook for risk assets, including Bitcoin, bullish into mid-2026. The charts tell a story, but it's not what you think. In the first chart, Coutts juxtaposes the USD commitment of traders caught index with the US dollar index. After a prolonged slide in the first half of 2025, speculative positioning flipped dramatically against the dollar, with the COT index plunging into negative territory by mid-2025. This extreme bearishness created the perfect conditions for a counter-trend squeeze. The chart shows the DXY clawing its way back toward the 100 to 101 area, a zone that aligns with previous congestion and the underside of this year's breakdown. Meanwhile, the COT bars remain below zero, suggesting this move is driven by short covering rather than a renewed bullish consensus on the dollar. Coutts' second chart overlays the global liquidity index with the inverse of the DXY. The two series move in near-perfect tandem. When the dollar weakens, inverse DXY rises, global liquidity expands, historically boosting performance for duration-sensitive assets like equities and crypto. Over recent weeks, however, the liquidity line has dipped modestly as the inverse DXY line has done the same. This illustrates Coutts' key point. A stronger dollar equals tighter global liquidity, which in turn dampens risk appetite and weighs on crypto. What does this mean for Bitcoin's price? Here's the unfiltered truth. When framed this way, Bitcoin's recent slip appears less about crypto-specific issues and more about broader FX mean reversion and futures positioning. The crowded short in dollar futures signaled vulnerability to a bounce, and the mean reversion target around 100 to 101 provided a logical stopping point. If the DXY stalls and resumes its downward trend from this level, consistent with the broader 2025 downtrend, liquidity conditions would likely ease again, reigniting demand for high beta assets like Bitcoin. However, if the index breaks through and holds above this zone, Bitcoin could face a more sustained headwind from a stronger dollar and slower liquidity recovery. The big picture, cyclical versus secular, and why it matters. Coutts remains constructive on Bitcoin's outlook despite the near-term challenges. He views Bitcoin's drawdowns on dollar strength as cyclical rather than secular, meaning they're part of a temporary ebb and flow rather than a long-term shift. The immediate pivot point is clear. The DXY's retest of 100 to 101, driven by stretched speculative shorts and classic mean reversion, is currently dictating Bitcoin's trajectory. At the time of writing, Bitcoin was trading at $121,703. Now, here's the controversial part. Is Coutts right? While Coutts' analysis is compelling, it's not without its critics. Some argue that crypto's structural flows are more resilient than he suggests, while others believe the dollar's rebound could be more than just a temporary blip. What do you think? Is Bitcoin's dip truly a macro-driven event, or are there deeper forces in play? Let's debate this in the comments, because the truth, as always, might be more nuanced than it seems.